No empire in history has ever collapsed solely because of a lost war. They collapsed because of a broken currency. Today, something strange is happening to the US dollar. It has plummeted 10% this year, marking its most violent decline since 1973. While mainstream media dismisses this as the erratic chaos of the Trump administration, the numbers suggest a far more calculated reality. This is not an accident. It is a controlled demolition. Behind the closed doors of Florida's private clubs, a strategy is emerging that insiders call the Mar-a-Lago Accord. It is a radical blueprint designed to intentionally weaken the American currency, challenging the very global financial order that the United States spent the last 80 years meticulously constructing. For decades, the dollar stood as the ultimate symbol of trade, capitalism, and American dominance. But that dominance came with a hidden, lethal price tag that has quietly hollowed out the American heartland. We have been conditioned to believe that a strong dollar equals a strong nation. But for the American worker, it has been a slow-acting poison. By keeping the currency artificially high, the U.S. government effectively subsidized foreign imports while making it impossible for domestic factories to compete. Now, Donald Trump and his economic team are preparing to engage in the biggest economic gamble in human history. They are attempting to deliberately sabotage the dollar's status as the world's reserve currency, to force a return of American manufacturing. The stakes could not be higher. One miscalculation could trigger a global financial contagion that threatens the entire world order. If this plan fails, the U.S. economy faces a disastrous backfire. If it succeeds, the purchasing power of every dollar in your bank account is about to be systematically erased. This is how they are dismantling the system from within, and why your financial future is currently lying on the operating table. To understand the present collapse, we must first dismantle the greatest myth in American economics, the belief that a strong currency is the hallmark of a healthy nation. For decades, the strong dollar policy was preached as gospel from the pulpits of the Treasury Department and the Federal Reserve. But beneath the veneer of global prestige, this policy functioned as a structural trap, the mechanism that enriched the financial elite while quietly euthanizing the American industrial heartland. The roots of this paradox trace back to the early 990s. Following the collapse of the Soviet Union, the United States stood as the unchallenged unipolar power. Simultaneously, on the other side of the Pacific, a tectonic shift was occurring. Nations like South Korea, Singapore, and eventually China were undergoing an unprecedented industrial metamorphosis. These Asian tigers were producing wealth faster than their internal infrastructures could absorb. They lacked deep, reliable capital markets and stable local banks to store this burgeoning surplus. This created what economists call a global saving glut. Instead of sitting idle, hundreds of billions of dollars in Asian savings were funneled directly into the United States. This massive influx of foreign capital birthed a golden age for the American stock market, which quadrupled in value in just a decade. It provided the easy money that fueled the birth of tech giants like Amazon, Google, and Apple. But this tidal wave of cash had a devastating secondary effect. It sent the value of the dollar soaring, climbing nearly 50% in a single decade, one of the most aggressive appreciations in monetary history. For the average American consumer, this felt like an era of effortless prosperity. When the dollar is strong, its purchasing power against foreign currencies increases. Suddenly, imported goods, Japanese electronics, Korean appliances, and Chinese toys became incredibly cheap. American homes were overflowing with products they had not worked any harder to afford. This was the prosperity illusion. While you were enjoying a cheaper Sony television, the structural foundation of your neighbor's livelihood was being dismantled. The mechanics of this poison are simple but lethal. Because the dollar was so expensive, American-made products became unaffordable on the global stage. If General Motors tried to sell a car abroad, the exchange rate acted as an invisible tax on the buyer. Even within the United States, it became more logical to buy it cheaper. As the factories began to go dark, the numbers told a story of a nation being split in two. On the surface, the economy looked magnificent. Average incomes actually rose by nearly 40% during this period. But this was a statistical lie, a weighted average designed to mask a brutal redistribution of wealth. In reality, nearly half of all that income growth was swallowed by the top 1%. Meanwhile, the bottom 50% of the population saw their share of the national income collapse from 20% to less than 13%. This is the grim reality of the strong dollar paradox. It created a nation of consumers who could afford everything but could produce nothing. It turned the American Midwest into a graveyard of rusted machinery, while the skyscrapers of Wall Street reached new heights of excess. For the skeptics who wonder why the social fabric of the United States is tearing at the seams, the answer is found in the exchange rate. The system was designed to make you feel rich while it stole your ability to earn. You were told the dollar was a symbol of strength, but for the millions who lost their dignity in the shadow of closed factory gates, it was the ultimate betrayal. The elites in Washington knew this, but the flow of foreign capital was too addictive to stop. Until now. This structural decay created a vacuum, a desperate need for a disruptor who would prioritize the factory floor over the trading floor. How did this economic frustration transform into a political revolution that would eventually lead to the Mar-a-Lago Accord? During his first term, Donald Trump's strategy was blunt. Use tariffs as a shield for American industry. In 2016, his administration slapped a 25% tariff on important steel, intending to force manufacturing back to the U.S. However, the results were a mathematical disaster for the very people he promised to protect. Estimates suggest that trade war cost the U.S. roughly 170,000 manufacturing jobs, while American companies were bled for an additional $46 billion in import costs. Instead of a roaring success, it was a structural backfire. The failure was rooted in a cruel economic paradox that the Trump team had not fully accounted for. Whenever Trump announced new tariffs, it created waves of global uncertainty. In the world of high finance, uncertainty leads to a flight to safety. Despite the chaos, the United States was still perceived as the most secure place to park capital. Consequently, global investors rushed into American assets, pouring an additional $200 million into the country. This massive influx of foreign money pushed the value of the dollar even higher. In a bitter twist of irony, the very tariffs meant to reduce reliance on foreign imports made American goods even more expensive for the rest of the world. The dollar became a wall that no tariff could overcome. This was the breaking point. The realization that you cannot rebuild an industrial base if your currency is so strong it functions as a trade barrier against yourself. Enter Scott Bessent, the man who would become Trump's Secretary of the Treasury and the architect of a far more dangerous philosophy. Bessent arrived at a controversial conclusion. The only way to truly bring back American manufacturing was to systematically devalue the dollar itself. But devaluing the dollar in the 21st century is nearly impossible through traditional means. Since the 1990s, the capital controls and direct interventions that countries once used to lower their currency value have been made practically illegal under modern trade agreements. History provides only one successful precedent for such a move: the Plaza Accord of 1985. Back then, the U.S. sat down with major world powers to collectively agree to lower the dollar's value. But in today's fractured geopolitical landscape, there will be no polite handshakes or coordinated agreements. The world has changed. China and other emerging powers have no interest in helping America regain its industrial edge. Bessent's theory, which quickly gained traction in Trump's inner circle, proposed a radical alternative. If the world will not agree to a new Plaza Accord, the U.S. must force it through calculated chaos. The strategy is to weaponize instability. By engaging in massive deficit spending, threatening relentless trade wars, and applying open political pressure on the Federal Reserve, the administration could intentionally destroy the dollar's reputation as a safe haven. The goal is to trigger a mass capital exodus. If investors begin to fear that the U.S. government is no longer a responsible steward of the world's reserve currency, they will stop buying dollars and look for stability in assets like gold or the euro. Only when the world stops wanting the dollar will its value finally drop enough to make a factory in Ohio competitive again. This is the intellectual foundation of what insiders call the Mar-a-Lago Accord. It is not a request for cooperation. It is a declaration of monetary war against the existing global order. They are betting that the short-term pain of a currency crash is the only way to cure the long-term cancer of industrial decay. But how do you execute a plan this radical without causing a total economic meltdown? The answer lies in a strategy of strategic unpredictability, throwing the markets into a tailspin only to pull back at the last second, leaving the dollar weaker and the world guessing. In the theater of global finance, stability is the oxygen of investment. By removing that oxygen, the Trump administration has discovered a potent, unconventional weapon: the strategy of chaos. This is the execution phase of the Mar-a-Lago Accord, where the traditional rulebook of the Treasury Department is discarded in favor of psychological warfare. Trump does not rely on complex legislation to move markets. He relies on the raw power of uncertainty to dismantle the dollar's safe haven reputation. The most vivid demonstration of this strategy occurred during the now infamous Liberation Day press conference. Trump unveiled a sweeping package of tariffs targeting not just rivals like China, but also long-standing allies like Germany. With rates soaring as high as 49%, the shock was immediate and seismic. Investors, who traditionally viewed the U.S. as a predictable bastion of capitalism, were suddenly confronted with an administration willing to set the global trade system on fire. The markets went into a vertical freefall. The Dow Jones Industrial Average plummeted nearly 8% in a single day, and Treasury yields spiked as the world scrambled to price in the end of globalization. But then came the fake-out and moved straight from the pages of The Art of the Deal. Weeks after the announcement, Trump quietly reversed course, walking back the most extreme tariffs and settling on rates that were only half of what was originally projected. To the mainstream media, this looked like a chaotic retreat or a failed policy experiment. But for the architects of the Mar-a-Lago Accord, the mission had been accomplished. The goal was not just the tariffs themselves. It was to shatter the market's confidence in the permanence of American policy. Even though the tariffs were rolled back, the psychological damage was permanent. Investors no longer knew if or when the hammer might fall again. Fear became a tax on holding the American currency. While Wall Street decried the chaos, the real-world effects began to appear in the very places the system had previously abandoned. In Michigan, auto exports climbed nearly 12%, as the weaker dollar made American cars cheaper for foreign buyers. In Texas, energy shipments rose close to 15%. Even the dormant steel and machinery sectors in Ohio and Pennsylvania saw a pulse of growth for the first time in over a decade. The plan is working, but it is a scorched earth victory. By deliberately making the dollar unpredictable, Trump is successfully devaluing the currency to save the factory floor. However, This revelation comes with a terrifying realization. The United States is now treating its own currency as a weapon of war. This leads to a chilling question for any investor. If the US government is willing to sacrifice the dollar's stability for industrial gain, what happens when the massive debt fueled by that same dollar finally comes due? The gamble has moved from the trade floor to the very foundation of the American debt machine. To save the factory floor, the Mar-a-Lago Accord is prepared to let the trading floor burn. This is the grand gamble, a high-stakes maneuver that prioritizes the Main Street producer over the Wall Street speculator. But in a system built on $36 trillion of debt, intentionally devaluing your currency is like performing surgery on a patient whose heart is made of glass. The immediate casualty of a falling dollar is the U.S. Treasury market. For decades, foreign investors were the primary buyers of American debt, providing a steady stream of capital that kept interest rates low. But as the dollar loses its safe haven status, these investors are staging a mass exodus, pivoting toward gold or other sovereign assets. When the biggest buyers walk away, the U.S. government is forced to raise interest rates to attract new lenders. They are betting that America can survive the fire they have started. The only question is, can you? Whatever the reason, whether this is a masterstroke of economic genius or a desperate political experiment, one truth is certain: the era of the unshakable dollar is over. In the final calculus of the Mar-a-Lago Accord, there are no clean victories. To save the factory worker in the Rust Belt, the administration is prepared to sacrifice the $401K of the office worker in Manhattan. This deliberate devaluation is not just a policy shift, it is a violent transfer of wealth, away from those holding depreciating cash and toward those positioned in hard, tangible assets. As a result, global capital began to hedge its bets, and the dollar continued to tumble, losing nearly 12% of its value against a basket of major currencies. This manufactured instability triggered a massive shift in capital flows. For the first time in decades, demand for gold surged to its highest level in over 10 years, as investors looked for an escape from the dollar's volatility. This is exactly what the skeptics and truth seekers in the financial community have long predicted, a moment where the system's lack of transparency forces a return to hard assets. With the national debt now surpassing $36 trillion, the math becomes catastrophic. Every 1% increase in borrowing costs adds roughly $360 billion to the annual interest bill, a sum that already consumes nearly 15% of the federal budget. This is the debt spiral. As interest payments balloon, the government must borrow even more just to pay the interest on what it already owes, further devaluing the currency in a terminal feedback loop. While the industrial heartland might cheer for a weaker dollar, the engine of modern American growth, Silicon Valley, is staring into the abyss. The current tech boom is not just built on code, it is built on extreme leverage. The past year, hyperscalers have issued record debt to fund the massive infrastructure required for artificial intelligence. This easy money era is the only reason 92% of growth has come from AI investments. If the dollar's devaluation forces interest rates to stay elevated, the cost of servicing this massive debt will double. For many speculative tech firms, this is a death sentence. We are no longer talking about a market correction. We are looking at the potential for a systemic AI bubble burst that could push the economy into a deep structural recession. At the heart of this chaos lies a century-old economic paradox known as the Triffin dilemma. It states that a country whose currency serves as the world's reserve must run massive trade deficits to supply the world with liquidity. This makes the world happy, but it destroys the domestic exporting industries of the reserve country by keeping its exchange rate artificially high. For 80 years, the U.S. prioritized global stability over its own workers. Trump's strategy is a radical rejection of this responsibility. He is choosing to break the reserve currency status to restore national sovereignty. It is a scorched earth policy. He is burning down the international order to rebuild the American internal order. This is the ultimate revelation for the self-engaged investor. The system is not just rigged, it is being intentionally dismantled by the very people at the top who realize the old model is no longer sustainable. The system is being re-engineered to favor the producer over the saver, and the collateral damage will be the purchasing power you once took for granted. Is this a stroke of geopolitical genius, or a desperate match struck in a room full of gasoline? Whether the Mar-a-Lago Accord can actually revive American manufacturing without triggering a total systemic collapse remains an open, haunting question. No one can say with certainty where this path leads, but the machinery of chaos has already been set in motion. The era of global stability, anchored by a predictable dollar, is being dismantled in real time. The old world order is dying. The illusion of a safe haven has been shattered by the very hands that built it. As the numbers on the U.S. debt clock spin toward an inevitable reckoning, the luxury of waiting is gone. What you do with your capital in this window of uncertainty will determine whether you are a victim of the devaluation or a survivor of the new order.